So the hammer confirmed the bullish engulfing pattern. And that's the answer to the question, why are these hammers likely to work? We're looking at the first one now, is because it's confirming a support area. And with that in mind, look at the hammer at 2. Same thing. It is testing a support area. You can see how it got a little bit under the support, but didn't close under it. And to me, the market really has to close under support to say that the market broke a support area. By the way, this is not a hammer. Why? Because the upper shadow is too long. So the answer to this question is, why are these hammers likely to work? And the answer is because they are both confirming support. So let's move on to part 3. Okay, what's happening here regarding the bull force? Now, isn't the market making higher highs here and mainly higher closes, or holding the closes, the highs near the close very well? So any signs of any problems? Of course. Okay, we have a series of small real bodies, spinning tops, showing us that although the market's holding the highs fairly well, the bulls really don't have 100% control of the market. And keep in mind, the market is not far from the resistance area set by the 2 dark cloud covers also. So the spinning tops, I don't think I'd be selling on them because, in my opinion, we're not quite close enough to a resistance area set by these dark cloud covers. But this keeps us out of a bad trade. One of the stellar aspects of the candles is it helps us avoid bad trades. So let those who use bar charts and see that the market's making higher highs or higher closes or higher lows go long. But now that we have the insights of the candlesticks, we would say to ourselves, hey, although the pound is moving up, it's doing so with small real bodies. We also have a couple, not major, but we have a series of some small upper shadows. I think we're going to hold back from the long side here and look at how much we would have saved from being long on this sell-off. Okay, and the answer is, as I mentioned, spinning tops. Just be cautious. Okay, let's move on to 4. Is this a piercing pattern? That's part A. And would you buy here? So, first of all, remember the piercing pattern has to go above the middle. The close has to go above the middle of the black real body. And obviously, in this case, it did above the middle of the black real body. So, the answer to this for part A, as shown here, is no, since the white candle didn't get more than halfway into the black real body. Because we want to see with the piercing pattern, is the bulls really counterattacking, really pushing deeply into the black real body. Now, the second part of the question is, would we think about buying it here, although this is not a piercing pattern? And again, this is very subjective, but I would think about it because the market's confirming a support level set by not only the hammer here, but the prior lows here. Okay, remember, we talked about this in the prior slide. This is not a hammer because the upper shadow is too long. So we have a support level. So the market is near the support area, right around here. And this is also a fairly good risk-reward trade. So I don't see anything wrong with buying it here. One of the things we could also do, and we had touched upon this in the DVD workshop, this is a daily chart, but you might want to look at an intraday chart because we may have had on an intraday chart some reversal signals down here in the first couple of hours of trading, which could have given us a buy signal. So that's one of the aspects, or one of the advantages of using intraday also, even if you normally don't. But I would see nothing wrong with buying it here, and my target would be the recent highs. Once again, my target might be very different than your target, so keep that in mind. But from my perspective, this would look like an okay risk-reward. Okay, any reason for caution here? Now remember, if we bought over here, assuming it's a good risk-reward, and it's just about 2 to 1, this is our target. Now, the market does this in this blue ellipse. Are there any reasons for caution to have us reassess, staying long, hoping to reach our target? And the answer is yes. Okay, it's a harami. It's a small real body in a large real body. Now, also, there's a falling resistance line. Okay, I really place a lot of emphasis. I really like horizontal support and resistance, because everybody's looking at the same level. But many people use angled trend lines. So, for example, here in this blue line, this blue descending line I made, this is a classic falling resistance line. Look how many times it was touched. 1, 2, 3, 4, 5, and 6. So we really have two reasons for caution here. We have the Harami, that is a candlestick signal, and we also have a classic Western signal a la the falling resistance line. Next, we're going to be looking at what I call what would you do slides. And what we're going to do is take a slide or a chart, and on the last session on the right, we would ask what would you do based on the candlesticks. Now, normally when we do analysis at our shop, candlecharts.com, for our institutional clients, or at our seminars, our live seminars, we'll also look at Western technicals in conjunction with candlesticks. But we want to focus now on the candlesticks. So based purely on the candlestick signals, we're at this juncture here. This happens to be a daily chart. What would you do? So put the player control on pause. So here we have a bullish engulfing pattern. The market was in a little bit of a downtrend, and we have a white real body wrapping around a black real body. The opening of the white real body might be a pip or two above the close of the black real body, but that's still fine for a bullish engulfing pattern in the Forex market. But the more important question, or equally important, is not only the candlestick signal, but let's always think about the risk reward. That's where money management comes in. So by the time we get the signal on the close of the bullish engulfing pattern here, this is our potential target. By the way, this is a bearish engulfing pattern. The black wrapping around the white. Actually, it wrapped around two small white real bodies, particularly ominous. And so this is our potential target. Again, your target might be a little different, but I just look at immediately preceding highs and lows and so forth. Now, our stop out level with the bullish engulfing pattern is the low of the bullish engulfing pattern. So in the blue arrow, that's our potential risk. So we could see, based on this risk reward, this would not be a trade that would be warranted. Now let's look at an example of another bullish engulfing pattern with the risk reward. So here in this green semicircle, we had another bullish engulfing pattern. And let's imagine that we don't know what happened after. In other words, we don't see any of this. Let's forget about all this stuff here. And the question is, this is a nice bullish engulfing pattern, nice insofar as it wrapped around 1, 2, actually 3 black real bodies. So we would say that's more significant as a potential bottom reversal. And we would normally say, or people who don't know that much about the candles would say, hey, look how well the bullish engulfing pattern worked. The market had a sharp rally after it. But in the real world, remember, we don't know what happened back here. We're only at this juncture. So we should be asking ourselves, okay, we have a bullish engulfing pattern. Yes, it wrapped around a multitude of black real bodies, but is this a good risk-reward trade? And to define risk-reward, we obviously have to first pick out what